Thank you all for joining the call today. Garrett, if you have the slides, we can kick it off. Tax benefits for rental properties and short-term rentals. My name is David Sanchez. I'm a realtor licensed in California, and I focus in Long Beach, LA, and the OC area. Today, we have Garrett that's going to talk about some of these benefits. So Garrett, if you can kick it off.
Yeah, my name is Garrett Steiner. I'm a CPA, which is a certified public accountant. That essentially means that I am licensed by the state of California. That doesn't mean I can only work with people in California, but that's where I'm licensed. Basically, it means I'm regulated. I prepare taxes for people primarily. David and I connected a number of years ago. He sold me my first home and told me about this group. He mentioned lots of his clients have tax questions that they ask him from time to time. He was hoping to have a resource to answer some of those questions that maybe he didn't know the answers to. This kind of tax seminar meeting originally started out as an individual tax question avenue. Ultimately, we had a lot of people ask about tax questions regarding their rental properties and short-term rentals. In the age of Airbnbs and things like that, people started having a lot of questions. We're really excited to share some of this info for you. Just a little bit about myself. I'm a CPA. I have been working in this field for going on, we'll call it 10 years. I help business owners, individuals, people with rental properties, people that need help with trust and estate area, kind of you name it. I help out with the tax situations for those people. So if you or anyone you know has questions, my info will be posted at the end of this, and feel free to shoot me an email, give me a phone call. I don't mind answering questions free of charge. And if you need help, I'm here for you.
Yeah, and Garrett's great. He does do my taxes, and he's given me some great. I had another tax guy before I met Garrett. Honestly, I love Garrett. There's a lot of things he told me, and I was like, oh, the other guy never told me that, and he saved me a lot of money in the end. This is a good page to take a screenshot. We're gonna have the info again at the end.
Without further ado, I just briefly want to cover the topics that we're going to be talking about. The purpose of the session isn't to get into super nitty-gritty details. This is really just to give people who are looking to maybe start a rental property or already have one just get more familiar with the situation from a very high level. The first thing we're going to talk about are what kinds of things you can deduct. The second thing we're going to talk about is some differences in what we're going to call partial use rentals, which we'll define later. And then last, we're just going to talk about some other specific tax things to keep in mind as they relate to rental properties. All right, so first, we're going to talk about what can you deduct if you're going to report a rental property on your tax return. And the first bucket of expenses we're going to talk about are what we're just going to call expenses that are ordinary and necessary. Now, this is the catch-all for everything when people ask, what can I deduct? And the first thing that, as a tax accountant, my brain is going to go to is, in your situation, what is ordinary and necessary? Now, that can be very broad, and so we're going to try and help define what that means specifically. The terminology that the IRS throws out are expenses that are common, they're generally accepted, they're helpful, or they're appropriate. What that means is, let's say you have a rental property. Now you want to take a trip to Barbados. This is not something that would be considered ordinary and necessary for a rental property in California. Would that be deductible? No. It's a little bit extreme, but sometimes I get these questions. More specifically, when you're looking at a rental property, you're looking at things like property taxes, the mortgage interest on that property, insurance, whether that's mortgage insurance, a fire insurance policy, earthquake insurance, as long as it's covering the property, are probably going to be ordinary and necessary and therefore deductible. Things like repairs, utilities. If your tenants aren't paying the utilities and you're paying the utilities, that's going to be a deductible expense. Maybe the property is part of a homeowners association. Those monthly dues are also going to be considered deductible. These do not cover everything. A lot of this is based on facts and circumstances. Sometimes people will have a management company that manages the rental for them. Those management fees are ordinary and necessary and would be considered deductible. So as you can see, this is a very broad bucket of expenses, but generally they have to pass some kind of gut check. And oftentimes this is what can be helpful to have a tax preparer for. I can't tell you the amount of times that I've had people come in and they didn't know, oh, what do you mean I could deduct the property taxes on that rental? What do you mean I could have deducted the utilities? And it becomes a large process to try and get them money back by amending years and years of returns that could have been solved had you just had a good person to ask these questions to. Now, the second type of expense here is depreciation. Depreciation is something you might have heard the word before. There's lots of things online that, oh, you're going to depreciate this and you're going to depreciate that. You maybe have never understood what that actually means. Depreciation is essentially when you buy something that you're expecting to last more than a year, the IRS doesn't let you deduct that entire purchase all at once in some cases. So when you buy the rental property, you can't just write off the entire thing all at once. The IRS requires that you write off a portion of the purchase price over a certain number of years. Typically, this calculation is done by a tax preparer, or if you file yourself, it'll be calculated by things like a TurboTax or a Free Tax USA, whatever software you're using. But the rules can be complex and there can be a lot of rules. And I have seen this done wrong more times than I can tell you. And it is sometimes helpful to have a second opinion on setting up these calculations. So what does a calculation like this look like? This example here, let's say that you've purchased your new rental property for $500,000. One of these rules says that we can't actually depreciate land. Unfortunately, we have to take out a portion that we're going to say is related to land, because when you buy a property, you're buying the structure, but in most cases, you're also buying the land underneath it. In this example, let's say that the land was worth half of that amount. Although you purchased the house for $500,000, only $250,000 of that is eligible for depreciation. Now, the IRS will give you a useful life that they determine. So this is where it can be helpful to have a preparer, because trying to figure out what the useful life is on individual things can be quite a process. Now, in this specific instance, a rental property is given a useful life of 27 and a half years, a very specific number. I don't know how they came up with this number, but this is the number they've set forth. Of that $250,000 value that we've determined is depreciable, if we divide that number by 27 and a half, our annual depreciation deduction is $9,091. This is just an amount that you get to deduct every year for 27 and a half years on your tax return that can go towards writing off a portion of whatever rental income you've made. It reduces your taxable income. We love depreciation. This is one of the reasons why rental properties are such a popular investment vehicle, because they might be cash flow positive, but they might not actually generate any taxable income. One of the reasons for this is depreciation, because you're not paying $9,000 out of your pocket to get this deduction. You're paying some other amount that might be completely different. Now, let's talk about partial use rentals. First, I want to define what a partial use rental is. There's two buckets I'm going to call. The first bucket is I own a property and I've owned it all year, but it's not available for rent half of the year. So half the year we're living there, half the year we're renting it out. That's a partial use rental. The second part is maybe I own a duplex and I live in the front part of the house, but the back of the house, or the mother-in-law suite, if you will, that's the part that gets rented out. That's also a partial use rental for purposes of this discussion. So all of the expenses that we talked about in the first slide, they're all still relevant for these partial use rentals. However, there's extra calculations we need to factor in because it's only partial use. We don't get the full expense in some cases. Let's say you have an Airbnb and you only rent it out during the summer months. From the months of June to August, you guys decide to rent this out. Those 3 months of the year are the only portion that we really get to consider the expenses related to that property. Now, that's in a situation when you own the whole property, but it's time-based. We're only renting it some months of the year. The other example, where we have a duplex, is based on we own the property and we're living in part of it all the year, but the part that we're renting out is also being rented out for the entire year. And you might be asking, I spent However much on property taxes, how much of that can I actually deduct if only half of the property is being rented? Fortunately, the calculations are relatively simple in a lot of cases. The generally accepted way that, in my experience, this is done is a factor of the square footage of the property. If you have a 2,000 square foot home and your mother-in-law suite, the duplex part is 1,000 square feet, and the part you live in is 1,000 square feet, we can split those expenses right down the middle and deduct those to the extent that you're paying them for the entire property. Let's talk about this example in more detail. Our example here is, let's say you own the duplex, and we're going to say that you own the property for the entire year. 50% of the square footage is related to the mother-in-law suite, and the 50% you live in. So something like insurance, let's say your mortgage insurance or your earthquake insurance policy covers the entire house. Only half of that is related to the part that you're renting out. Therefore, of your $5,000 of insurance, only $2,500 can be used to offset your rental income. Similar thing for property taxes, for utilities. Now, where this gets a little more complicated is, let's say I do a repair specifically to the mother-in-law suite. I replace the roof, I replace the windows. Because that repair is done specifically to the rental property, we can still deduct all of that. In a lot of cases, what I'll have people ask me is, we replace the roof for the entire property and half is for the rental and half is not. You have to do some math here and figure out square footage wise what is related to the rental and what is not. A lot of times this is something that your tax preparer would help you out with. If you're someone who self-prepares, this is important to keep in mind, because I've seen instances where people have not done this math and God forbid they get audited and the IRS says, you can't deduct all this stuff, this isn't related. And then they end up getting an assessment and having to pay all sorts of money back to the IRS because they just didn't understand that you have to prorate these expenses between the two kind of things that are happening within this property. Now, the last thing we're going to talk about here is what I'm going to call the character of the income of that rental property. The IRS has classifications for different types of income. For this purpose, we're going to talk about active income and passive income. Generally, rental income is considered passive. While you might go to work and get a paycheck every week for your W-2 job, that is active, but for a rental property, that is considered passive. This is important because the IRS treats these differently and allows you to deduct things for one and maybe not the other. Let's say you're making $200,000 a year from your W-2 job, and then on the side, you also own a rental property. Now, in our first example, let's say you have $40,000 of rents, and then you have $30,000 of rental expenses. Those expenses could be property taxes, insurance, and depreciation. Our net rental income is $10,000. We have our W-2 income of $200,000. We add that to our rental income of $10,000, and our total taxable income would be $210,000. The second example is where things can get a little hairy. Some people will say, I have $200,000 of W-2 income, but my rental property usually generates a loss. So let's take that same example. We have $40,000 of rents, but let's say we have $50,000 of rental expenses. This is usually the more common scenario in my experience, especially when you have properties in very expensive states like California. It's expensive to maintain that property, and typically the rental is not going to generate net income for those reasons. Although we have a net loss on this rental property in example 2, we have a $10,000 loss. In fact, our taxable income, you'll see, is still $200,000. We can't use that $10,000 loss from the rental property to offset our income from our active W-2. Now, you might think, well, that's unfair. I just don't get this loss. Fortunately, that loss, although you don't get it immediately, does carry forward forever until you get to finally use this. So let's say down the road, 20 years from now, that rental property has $40,000 of rent and no expenses, just in an extreme example. All of those losses in previous years that had been suspended, you now get to use against that income. Eventually, you will get to use these losses, but it's oftentimes not in the year when that loss is first generated. This is important to remember because sometimes people think, oh, I'm spending all this money to upkeep my rental, but at least I'll get some tax savings from that. Because unfortunately, in a lot of cases, you don't get those losses. Now, there are some exceptions for people who make less than $150,000 a year. Some of those losses can be used even if you have no passive income, but that's beyond the scope of what this call is about. I just want to point out that it's not for everyone. I use $200,000 of W-2 income for a reason so that we're not in that area where we have to talk about what that exception means. That kind of concludes the things that I wanted to talk about with this meeting. If you have any questions, feel free to drop them in the chat and we can talk about those. Otherwise, I'm going to turn this back over to David and he can talk about some events that are coming up.
Great. Yeah, thank you, Garrett. I appreciate that. And that was great. I love how you went through everything in detail and know that you still might have steam coming out of your ears, which is very normal. So know that you could always call Garrett and he can, of course, go more in depth on certain situations that you guys might have.
I'm going to add on to that because that's a great point. Sorry to interrupt, David. There's a lot of numbers, and I do this on a daily basis, so sometimes I can forget that what I'm talking about might sound like a foreign language. But if there's any questions on things that I talked about, or maybe you think your situation is a little more specific or complex, feel free, shoot me an email. I'm not going to send you an invoice for answering a question or taking a call. I love answering this information for people. I hate when new clients come in the door and they tell me, oh, I've had this for 10 years and I never knew this stuff, because I think as tax professionals, we can sometimes fail people just in terms of giving them the information they need to make informed decisions.
Thank you for clarifying that. We do have a question. We'll get to that in just a second. This is just a slide from one of my other calls where hopefully, if you guys in this situation, a lot of you have already maybe purchased a home already and you're looking at a rental income, or you're thinking maybe in the future. But I do have another call that is for first-time home buyers. That's a really good one. If you need a refresher or if you've never purchased a home before, that's a really good one where I go through the process from start to finish. There's also a tax benefits for homeowners. That's the call I normally do with Garrett. Usually we do it about once a quarter, and that's a really good call. He talks about some other tax stuff that's a little different than this one. And then another one call I do usually once a quarter as well is a home inspection deep dive. That's a great one just so you know what to look for. I have a home inspector that comes on and they tell you what they look for. So now I've learned so much from that call or just meeting with inspectors in general. Now I know what to look for whenever I'm looking at home. Whenever you're in an open house, you have an idea of what you're looking for. Most of you on the call today joined on Meetup. But if you want to scan that QR code, just take your phone and you scan with the camera function. Then it'll pop up on the Meetup and you can see the couple of events we got going on. We have one coming up next Sunday for the first-time home buyers. So that's a good one. And then the next slide. This is a great screen to take a screenshot of as well. If you do have Instagram, or even if you don't, you could still take that with that camera function on your phone, go over the QR code, and you can see I post a lot of educational stuff on Instagram. You could see a lot having to do with housing, but you can learn a little bit about me as well. I still try to make it fun. Sometimes real estate doesn't sound exciting for everyone, but I try to put a positive spin on it where it seems more entertaining, I would like to say. You could learn some stuff along the way. My phone number is on there. You can call or text anytime and I can answer any real estate questions. You also have Garrett's info on there. Garrett, what's the best way to reach you if someone has any question?
I would say email is probably the best. That's the one you're going to get the quickest response to. David and I are both based out of California. Although I am based out of California, I have clients all over the country. I have some clients that actually live abroad. So don't think that just because you're not in California, I can't help you. Even if it's just a question, I'm familiar enough with other states that I can give you a good place to start from.
That's a point. Garrett, I just sent you a question that someone asked. You could look at that in just a second. You brought up the different states. We've had a lot of people on the call too, where in California, things are very similar to a lot of the other states. So even if you go a first-time home buyer, you're not in California, a lot of the stuff we go over is going to pertain to you. It might be 95% the same. If you needed someone from another state, know that I have a lot of agents that I know in different states that I can refer to you as well. Florida, for example, I know a lot of agents in Miami, Orlando. I could be a resource for that. Good to know that Garrett can help in all those areas. Did that question come through, Garrett?
I'll go ahead and read the question out and then we can talk about it. The question was, is depreciation impacted by any work you do to the property to increase its value, or is it only based on the purchase price? Depreciation is generally relevant anytime you spend more than $2,500 on a single item or improvement or project. Let's say you buy the house in 2024 and you repair the roof and you spend $10,000 in 2025. That is also applicable for depreciation. Every time you spend more than $2,500 on a single thing, it becomes relevant to calculating additional depreciation. When you prepare a tax return, there's going to be a list of all of these things somewhere in your tax return that have been depreciated. Things like fridges, cabinetry, roof repairs, fences. Every time something like this happens, we have to do another calculation. So yes, it is impacted by additional work done to increase a property's value.
Thank you all for joining the call today. Again, whether you need help now, 6 months, 6 years, know that we're available to help you and you could ask any questions and give us a call. Thank you all for joining the call and have a lovely weekend.